Hi everyone, welcome back to Web Educate. In this video, we are going to explore fundamental principles of double entry bookkeeping and walk you through the step-by-steps to take in analyzing and recording financial transaction, and also action to take when a transaction occurs in a business organization. You may be a business owner, an accountant, is an accounting student, or a learner, a beginner of what? Of accounting. Understanding the principles that I've mentioned, all these principles are very fundamental to accurate and reliable recording of a financial transaction for the financial statement to represent true and fair view of the organization. So in this video, we are going to cover what is double entry, how to analyze transaction based on the effect of transaction. The effect as per when assets increase. What do you do? When assets decrease, what is the action to take? When liability increase, what is the action to take? When liability decrease, what is the action to take? When equity increase, what is the action to take? When equity decrease, what is the action to take? Towards the end of the video, I'm going to give you the 5 golden rules of accounting. 5 golden rules of the accounting. All these are very, very crucial and fundamental to understanding financial accounting as regarding the bookkeeping of transaction in a business organization. So, we are going to dive into action now by defining what is double entry, and also define the terms transaction. So I'll start with double entry system or double entry bookkeeping. Double entry system. This is a method. This is a method of recording transaction of recording transaction in which each transaction is recorded in at least 2 accounts where one account is debited bracket, let me put it this way, is debited, and another corresponding account, or another account, and another account is credited, in brackets, CR is credited simultaneously with the same amount. Double entry system. This is a method of recording transactions in which each transaction is recorded in at least 2 accounts, where one account is debited, DR represents debited, and another account is credited, CR represents credited, simultaneously with the same amount. So this is what double entry bookkeeping system. I rub off. Transaction. Transaction is an event. That affects a company financial position, such as A, purchasing or selling goods, such as purchasing or selling goods on cash or credit basis. B, payments or collections of money, payments or collection of money for goods and services, for goods sold or services rendered. C, borrowing or repaying loan. Borrowing or repaying loans. or repaying loans. D, paying expenses, or receiving revenue. And E, issuing or buying back shares, or buying back shares. Transaction is an event that affects a company's financial position, such as A, purchasing or selling goods on cash or credit basis. B, payment or collection of money for goods sold or services rendered. C, borrowing or repaying loans. D, paying expenses or receiving revenue. E, issuing or buying back shares. These are examples of transaction, and this is what the definition of transaction. So we go to the examples. We go to the examples. We go to the examples. I start with transaction. I open a table, transaction, effect, and action. Actions to take. So I start with number 1 example. On 1st May 2022, T and K started a bottle water business. Putting $50,000 into a bank account, especially for the business. This number 1 example. On 1st May 2020, T and K started a bottled water business, putting $50,000 into a bank account, especially for their business. So, to analyze the effect and the actions to take, I will start with the debit side of the action, followed by what? By the credit side of the action. But I must first analyze the effect. So what is the effect of this transaction? This is a transaction. On 1st May 2020, T and K started a bottled water business, putting $50,000 into a bank account, especially for the business. What is this? What are these involved? in the beginning of the video, we said we are going to cover assets, liability, and equity. So the effects, all these effects are going to cover, this transaction are going to cover assets, liability, and equity. When assets increase, what is the action to take? When assets decrease, what is the action to take? When liability increase, what is the action to take? When liability decrease, okay, let me put it this way. This is part of the golden rule I say I'm going to give at the end of the account. There are 5 golden rules, but I'm giving 3 now. When assets increase, the action to take is debit. When action decrease, the action to take is to credit. When liability increase, the action to take is to credit. When liability decrease, the action to take is to debit. When equity increase, the action to take is to credit. When equity decrease, the action to take is to debit. The arrow here represents increase, decrease, increase, decrease, increase, decrease. Asset increase, you debit. Asset decrease, you credit. Liability increase, you credit. Liability decrease, you debit. Equity or capital decrease, you credit. Equity or capital decrease, you debit. So these are the rules to follow for our double entry actions to take. So what is here? Is it an asset or liability or equity? So put on 1st May 2020, T and K started a bottled water business, putting 50,000 into a bank account. The money in the bank account, what is an asset? The money put into the bank account, especially for the business. When you put a money into a bank, especially for the business, that is capital. That is, the owner of the company introduced capital. So, the effect here was concerns what? Asset and equity. Another word for equity is what? Is capital. So when assets, let me just demonstrate like this. Assuming this is an asset account, right? Let's say bank. But you put money into what? Into a bank account. What is the meaning of the increase? Increase means, let's say, when assets increase, what do? Let's say, yesterday, there's some money in the bank account. The amount there what is $0. But today, being 1st of May 2020, for example, the owner put some money into a bank account. That means from $0 it has increased to $50,000. That is meaning of what? Of increase. These are very, very fundamental. Increase, decrease, increase, decrease. What do you mean? That is what you mean. Then, into a bank account, especially for the business. And see, especially for that is the capital that the owner introduced. When the capital increase, let's assume that this is the capital account. This is a capital account, right? And let me put the dollar sign here. The dollar sign covers both debit and debit credit. Debit credit. So when equity or capital increase, what do? You credit. Let us know that yesterday the owner has now started, has now introduced business money into the business. So the amount here was 0 yesterday, but today he introduced capital into the business. He put money into a bank, especially for the business. That means the capital account has increased to $50,000. And this is what we call double entry. Like I said in the definition of double entry, the double entry bookkeeping is the recording of what? Of a transaction in which each transaction is recorded in at least 2 accounts, where one account is debited and the other is credited, or where one account is credited and the other debited, right? These are the accounts: asset accounts, liability accounts, equity accounts. But the two effects, at least there must be 2 effects. And the 2 effects affect asset and equity. Asset, the money in the bank pot is an asset. The capital that is introduced into the what is the capital of the owner. So what is now the effect? The effect now is that A, let me put, for simplicity's sake, I'll be putting A and B. The first thing here is what is the asset of money in the bank increased, and I will be showing the arrow to show that what it increased. And I said when assets increase, what do? You debit. The action to take is debit bank accounts with $50,000. That's action to take. And that's what we do here. Then what is this second effect? B. We said the second effect is that you put the money into a bank account, especially for the business. That is introduce capital. And that is what I've demonstrated this here. So when capital, that means the capital has increased. And when capital increase, what do? That is capital of the owner increase. Capital of owner increase. And the arrow result to demonstrate this is, let me put this arrow, let me put it like this. This is to debit, and this what or let me not, so as not to confuse us, I put A and B. A is to debit, and B is to what? Is also is to credit. Credit capital account with the same amount. That is double entry for you simultaneously with $50,000. So that is the example 1. I rub off this to show another example. So, and I underline this. This is especially for the business. Second, on May 3rd, 2020, T&K. Who is T&K? T&K is the owner of the business. T&K bought equipment on credit. T&K bought equipment on credit from Tunes. From tunes. For $15,000. I will continue. Like I said, we are going to cover liability, asset, and equity. Assets, liability, and equity. In the balance sheet, or let me put it in the order as it is in the balance sheet. Equity comes first. Equity comes second, and liabilities. So this is, like I said, when assets increase, you debit. Assets decrease, you credit. Equity increase, you credit. Equity decrease, you debit. Liability increase, you credit. Liability decrease, you debit. So now, this scenario, this example, is it assets or equity or liability? On May 1st, 2020, T&K bought equipment on credit from Tunes for $15,000 from Tunes. So, bought equipment. Equipment is what is an asset. And when T&K, the owner of the business, bought it, he bought it on credit. Like we say, transactions is when you buy on credit or on cash basis. So when you buy on credit basis, you are going to write the name of the supplier or whoever that you bought it from. But when you buy on cash basis, it is bank that you are going to write as the account. But in this case, the account is what? Tunes account and equipment account. So is this asset, equity, or liability? Equipment is what? Is the asset account. And let me demonstrate like as I did before. This is the asset account. I put the second one because there's no space here. This is what? The asset account is what is going to be equipment account. And for clarity's sake, let's assume that yesterday there was no money here, but on 3rd of May, we put the date here, on, then the dollar sign on May 3rd, 2020. Let's say yesterday being May 2nd, 2020. The company don't have equipment, but today the company have what? Bought equipment on credit. What is the monetary value of that equipment? That is 15,000. So, equipment is what? Is an asset account. Equipment is what? Is the resources that the company will be making use for the business. So, equipment is what? Is an asset account. So, when that means, let's assume that yesterday being 2nd, there was nothing here. Let's say it's 0. But today being May 3rd, the company what? Bought equipment. The equipment has the value. The value of the equipment what is $15,000. So that means from $0 yesterday, the equipment account has increased to what? Increased to $15,000. $15,000. You can see. So, and when we say equipment is what is an asset account. So when asset increase, what do? You debit. So what is now let me put the effect here, like the other one. The first effect here is what? Is A, of equipment, assets of equipment increased. If I like, I can still put the, but for repetition's sake, let's just leave this place with the amount. Let's put the amount here. Asset of equipment increased. So when it increased, what do you do? When asset increase, what do you do? That is, the arrow is there, increase. And when asset increase, what is the action to take? You debit equipment account. The action here is a debit equipment account. Wait, what is the amount? $15,000. This is the principle. Fundamentally, for financial recording of transaction. That is fundamental. These are fundamental. If you don't get this fundamental principle, no way. No way for you to understand accounts. And some people will be saying accounts is hard, accounts is hard. No. You have to grant and grasp what? The fundamentals of accounts. These are fundamentals. And that is what we did in our last video about financial accounting on effect of a financial transaction on balance sheet items and how balance sheets are being balanced when a transaction takes place. These are what actions to take. With this double entry, balance sheet must balance. It must balance. So we need to understand this principle very well. What is the second effect here? Let me still take you with this because there's no space here. Let me write assets. Assets increase, you debit. Asset decrease, you credit. Equity increase, you credit. Equity decrease, you debit. Then liability increase, you credit. Liability decrease, you debit. The video may be too long, but the principles are very, very important. Are very, very important for beginners of financial accounting, for students, even accountants. There are some accountants that, you know, the fundamentals, you don't grasp the solid fundamental, you don't grab it. But with this principle, you know what is increase, decrease, increase, decrease of assets, liability, equity. So when liability decrease, this one, sorry, like I said, this transaction cover assets, it cover assets and liability, cover asset and liability. Why asset? Because asset, equipment what is an asset. Why liability? Because equipment bought from Tunstuns on credit. And I said when you buy on credit or you sell on credit, this is a liability. If you sell on credit, your customer is liable to you. If you buy on credit, you are being liable to your suppliers. Now, T and K is liable to Tunstuns, and that's what we call what? Liabilities. So, what is the other account? The other account is the liability account is Tunstuns, is the one that supplies. You have not paid, you are liable to Tunstuns. That's, we must open Tunstuns account. This is a short form of writing account because there's no space, it's allowed. So when liability increase, what do? You credit. Credit, debit, debit, credit. Debit side, credit side. So when liability increase, what do? You credit. You credit. And I say, for example, what do I mean by increase and decrease? For example, today, what is this date? 3rd of May 3rd. method, let me just take it, put it this way, method. So what do you do here? Assuming yesterday, being 2nd of May, there is no, Tunsun did not settle T and K. So his account with us is what is? His name is 0. But today, being 3rd of May, he sold equipment to us worth of $15,000. That means this account, liability account, has increased from 0 to $15,000. So we supposed to have the corresponding entry, but for simplicity's sake, okay, the corresponding entry what is equipment account, and here is what is a Tunsun's account. This is what we call double entry. See, Tunsun's account. What is the corresponding entry? Equipment account, and that is equipment account. For equipment account, what's the corresponding entry? Tunsun's account. So that is that. So assets increase, you debit. Liability increase, you credit. So the effect is what is B, the liability of money to Tunsun's has increased. Liabilities of money owing to Tunsun's, let me rub off here, to Tunsun's increased. And what is it? You put arrow to show increments. So what is the action to take regarding the liability? You credit. Credit Tunsun's account with what I've just shown here as regarding account with $15,000. So that is second example. That's second example. So we go to the third example now. But before that, I have to rub off. To enable me have space. I have to rub off. We go to example. Third example. Transaction, effect, and the action to take. Transaction, effect, and the action to take. Transaction, effect, and the action to take. If at this point, to this point of the video, you have derived any value at all from the video, please. If you're a new subscriber, please do share our video to your friends, students, or whomever that may have the advantage of our video. So, and don't forget to subscribe. When you subscribe to our video, it shows that you are supporting us and you want us to continue to upload more videos like this, more valuable videos like this. So continue to help us by subscribing and help us share our video with others, for others to also subscribe to our channel to have a wider coverage. And so in case you may need tutoring, you want tutor on financial accounting or another related accounting courses, I put my phone number here don't hesitate to 0033823412. So you give me a call or DM me on my number. This is my WhatsApp number also, 08033823412. And one more thing, in a former video of about 2 or 1.5 years ago, the videos were not clear. Apology for that. But subsequently, and for about past video that we have uploaded for about 2 or 3 weeks now, they are cleared. So, and it's going to be also be clear. We have not get there yet, but gradually I'm going to get there. So, don't forget to subscribe. So we go to example 3. Example 3. On May 1st, on May 4th, 2020, T and K withdrew. T and K, that's the owner of the business. T and K withdrew $5,000 cash from the bank. And place it in the card box and placed it in the card box. So I repeat again for simplicity's sake. I've always put it. When I talk about what we are going to cover here, what we are covering under the video is what is assets, equity, liability. Assets increase. What do? You debit. Asset decrease. You credit. Equity increase. You credit. Equity decrease. You debit. Liability increase. You credit. Liability decrease. You debit. So the question to ask now is this: what is the effect of this? Or, sorry, what is the classification of what happened here? Is it asset, equity, or liability? On May 4th, 2020, T and K withdrew $5,000 cash from the bank and placed it in the cash box. He withdrew $5,000 from where? From the bank. And what is bank? Bank is what is an asset. The money we have in the bank that the T and K has in the bank is what is an asset. So this involve what? Assets. It involves, on the first case, asset. Then we drew 5,000 from the bank, place it in the cash box. When he withdrew assets from the bank, he now places what? In the cash box. That is from bank to cash at hand. You see what? Cash at hand or cash in the box, what? Is still what? An asset. That means asset and asset. This is what is asset and asset. So when assets increase, you withdrew 5,000 from the bank. That is asset decrease. You credit. Then you now place it in the what? In the cash box. Let's assume say this is the cash account. Let's assume that, and I say this is what? Asset of cash increase. That is the effect. But let me demonstrate with you debit when assets increase. Let's assume that yesterday T and K has not withdrawn money from what? From the bank, and has not placed what? In the cash box. Then the cash account what? Was zero yesterday. But today, being 3rd of May 3rd, Yesterday, let's assume what? The money here is what? Is 0. But now we drew 5,000 from bank account. You want to use the money, now place what? In the cash box. So the 5,000 you place in the cash, that means from a 0 it has now increased to what? To $5,000. So I clean this, I change it to what? To $5,000. You can see it has increased from 0 to 5. That's the meaning of what? Increase that I said. So another account that we're going to have here, I put it here. Don't bother why am I putting it, just for example. What is necessary here is what is transaction, effect, and action. But I'm demonstrating with the account and this for clarity's sake. Okay. If we drew money from what? From bank, that is asset of bank has reduced. So when bank, this is bank account, I said it is allowed, A/C is allowed, that's the account. So asset of bank decrease. When asset decrease in the bank, what do you do? When money decrease in the bank, that is it. You credit. Asset decrease, what do you do? You credit. That's credit side, debit side, credit side, debit side. Right? So when asset decrease, what do you do? So assuming that yesterday we have money in the bank, which is $50,000. When the owner introduced, as we started from the first example, introduced $50,000 into a bank account, which being the what? The capital for the purpose of the business. So, but look at this now. This 5,000 now reduced. Yesterday it has not reduced. You don't debit. You see what? It's still 5,000. It's still 50,000. But today, the owner withdrew what? 5,000 from it. When asset decrease, this 50,000 now decrease to what? Decrease to when you do 5,000. What happened to this 50,000? That means the asset of what? Of bank has decreased to what? To 45,000. 45 plus 5,000. 45,000 plus 5,000 is not 50,000. So from 50,000 I decrease what? To 45,000. When asset decrease, what do? You credit, and that is that. Two accounts. So effect A here, debit first and credit. Debit. The asset of money in the bank reduced. In the cash box. In the cash box increased. And when assets increase, what do? You debit. Debit cash accounts with the amount that is $5,000. Then what is the other? What is the other effect? B. Other effect. B. That's in the bank. Money reduced. Assets of money in the bank. Assets of money in the bank reduced. Assets of money in the bank reduced. What is the effect? Reduce. What is that? Is the effect. The asset in the money what? Asset of money in the bank. That's the effect. The asset of money in the cash box increase. That is the effect. So when asset decrease, what do? The action to take is what? Credit bank accounts. Credit bank accounts with the same amount, $5,000. Right? That is not the sample. That's not the sample. Let's go to fourth example. Let's go to fourth example. On May 7, 2020, T and K bought motor van. 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 Paying by check. Whenever you pay by check, that is bank account. Paying by check. What is the amount? $10,000. I always demonstrate. Let me put assets, equity, and liabilities. When assets increase, you debit. Asset decrease, you credit. Liability increase, you credit. Liability decrease, you debit. Sorry, equity increase, you credit. Equity decrease, you debit. Liability increase, you credit. Liability decrease, you debit. Right? Right? So let me show you the effect now. What is the first effect? T and K bought motor van. That's transaction. What's now the effect? He bought motor van. The effect is that the asset of motor van has increased. Pay by check. 10,000. That means he paid that money from which account? That is from that capital that the owner introduced. Right? So that the owner, because he has not made profits that will increase the capital. So it's still the same capital. So the money in the bank as well as reduced. That's the effect. The motor van, assets of motor van increase, then assets of bank in the what? In the assets of money in the bank decrease. That's the effect. One increase, one decrease. But which one did this transaction affect here? Motor van is an asset. Motor van is what? Is an asset. Then money in the bank also is what? Is an that means asset. Assets of motor van increase. Assets of money in the bank decrease. Assets. That's so. Then let me demonstrate with accounts again. For clarity's sake, let's assume I will always start with the debit side first. That means motor van. Assets of motor van what? Motor van increase. When assets increase, what do? You debit, right? Debit, and I always showed. Let's assume that yesterday, what is today? Today is May 7. May 7. May 7. So, May 7. Yesterday, being May 6. T and K has not bought motor van. But today, being May 7, when he has not bought motor van, the asset what? The motor van account what? Is 0. But today, being May 7, he bought motor van worth of 10,000. That means the account has increased from 10,000 from $0 to $10,000. You don't write 0 like this. And just for simplicity, for example, for clarity, so that to illustrate what do we mean by increase, decrease. That's the meaning of all this one that I'm putting 0. $10,000. It increased from 0 to $10,000. Right? Let me show the other effect, the other asset effect. to debit. There's no space. That's why I'm putting it this side. That's why I'm putting it this side. So what is the other? It's still asset. That means money paid by check. That means money in the bank has reduced. So you open what? Bank account. All these are very fundamental to financial accounting. If you must understand what is, if you must have a solid grasp of financial accounting, these are fundamental. So what do you do here? Bank asset in the bank decrease. When asset decrease, what do? You credit. So you come to the credit side, and like say yesterday. What is the date here? The date the transaction happened, that is May 7. Assuming yesterday being May 6, nothing happened here. Let's say he has not withdraw money from the bank. He hasn't withdraw money. Here is what is 0. Here is what? Here is 0. So, but now, sorry, we have a 50,000 there before. Then from the 5,000 in the bank account, you withdraw 5,000. It remains 45,000, right? It remains 45,000, right? So let's assume yesterday being May 6, this account still remain what? 45. Then when this asset of money in the bank reduce, what do? You withdrew 10,000. Abi? Bought motor van, paying by check, 10,000. The money is still using what is the money in the bank. You have 50,000 there before. You withdrew cash of 5,000. Abi? From what? From the bank. You withdrew 5,000. So the money reduced to what? To 45. So further reduction. It still reduced. You still went to bank and collected 10,000 to buy what? To buy motor van, $10,000. So $10,000 here. When assets of money in the bank reduce from 45 to what? To 35 now, right? When it's reduced, you can see 35 plus 10, that is 45. That means it has reduced from 45 to 35. It reduced by what? By 10,000. When assets reduce, what do? You credit. Look at it. Asset decrease, what do? You credit. So that is the double entry principle that we say we are going to cover. So what is effect number 1 here? A, effect is asset of motor van, assets of motor van increased. And when assets increase, what do? You debit. That means the action to take what is debit motor van account, debit motor van account. Wait, what is the amount? 10,000. $10,000. What is the second effect? B. Money in the bank. Money in the bank reduce, and that is what we demonstrated here. That's what we demonstrated here. Assets of money in the bank reduced. The money in the bank reduce. Then when assets reduce or decrease, then what do? You credit bank, because it's on the bank. What I just rub off now. Credit bank account. Credit bank account, weight $10,000 dollar. As I've just shown in the account I just opened now. So I rub off and go to example 4, no 5, 1, 2, 3, 4. I go to 5, example 5. For simplicity's sake, for clarity's sake, let me rub off this one. Look at it. This is it. Look at it. So, this is the transaction, effect, and action. So we go to number 5 example. We go to 5th example. So I rub off. Number 5 example. 5 example. On May 10, T and K sold some equipment that were sold some equipment that were not needed. They were not needed. At cost of $2,000 on credit to J. Jerome. For simplicity's sake, let me put it again. Assets increase, you debit. Assets decrease, you credit. Equity increase, you credit. Equity decrease, you debit. Liability increase, you credit. Liability decrease, you debit. The effect now, what is the effect? On May 10, 2020, T and K sold some of the equipment, and then because of some of the equipment, they were not needed at cost of $2,000 on credit to J. Jerome. What is the first effect? So some equipment, they were not needed at cost of $2,000 on credit to J. Jerome. Look at it. Equipment is going out. That equipment is decreasing. What is the action? You credit. But I say I will always put what? Debit, because debit, credit. So what is the other effect? There were not equipment that were not needed, sold to J. Jerome at the cost of $2,000. J. Jerome now is what? Is our customer, is T&K customer. He bought good from them. We are keeping his account with us. So J. Jerome is our customer now, right? But because he bought on credit, that's why we are going to write his name. Otherwise, assuming he paid us by check, we are going to open bank account, or he pays all the cash, we are going to open what? Cash account. But because he has not paid, then we have to open J. Jerome. That means J. Jerome is what? Is receiving what? Is receiving what? An asset. So J. Jerome now is receiving what? Some equipment. But we are not going to put equipment here. We are going to debit J. Jerome because it's the one that received. So J. Jerome account. So assuming yesterday J. Jerome has not received anything from us, is at the account of J. Jerome in our what? In our book, what is 0. But today being May 10th, J. Jerome has what? J. Jerome bought equipment worth 2,000 from us. That means this J. Jerome account has increased from $0 to $2,000. And J. Jerome is our customer. We sold to him. He has not paid us. But he's going to pay us in the future. The money that we're going to receive from him in the future, what is going to be our asset, right? It's our asset. Even though we have not collected it, but is what is still our asset. When we collect it from him, it's going to enter our what? Either our cash account or bank account. The money with J. Jerome is still our asset. So that is J. Jerome now being is an asset account. So today being May 10th, he received what? Equipment worth of $2,000 from us. That means the account has increased from $0 to $2,000. So the corresponding account is what is equipment account, because there is no space for it. Let me just put it. Equipment account. Right? So what is it? Let me open the second one. Equipment account. Equipment account. Okay. Equipment account what? Decrease. When we bought equipment from Toonstoons, right? The equipment that we bought from Toonstoons was what? Was $15,000. When we bought equipment from Toonstoons, $15,000. Right? We have not sold from it because equipment is not what Toonstoons sell. We don't know its business. But equipment is what they are resources that company use either to manufacture or to produce products. So it's not goods, right? But because maybe it did not name part of it, it's so part of it. So yesterday, the money was still $15,000. But today, being May 10, right? Today being May 10, from this equipment, T and K is the owner of this equipment account. He sold $2,000. So equipment worth of $2,000 to who? To J. Jerome. J. Jerome account. Sorry for this. It will not be clear, but this is J. Jerome account. So yesterday, the equipment that T and K have was $15,000, right? But he sold $2,000 out of it. Now he reduced, that asset reduced from $15,000 to now reduced by what? By $2,000. That means from $15,000 you now reduce to 13,000, right? 13,000. So when asset is reducing, what do? You credit. When asset is increasing, what do? You debit. Asset increase, what do? You debit. Asset decrease, what do? You credit. The effect here is what? Is asset and asset. Asset and asset. Asset of Jerome, then asset of equipment. You see within what? Asset account. So what is the effect A now? Effect A is that the money with J. Jerome the money owed to us by J. Jerome has increased. The asset of money owed by J. Jerome to T and K increased. And when asset increase, what do? You debit J. Jerome accounts. The video may be long, but these are the fundamental. Honestly, these are the fundamental of accounting. If you get it this way, with the sum that will be given, that is just asset, liability, equity, asset, liability, equity. So what happens? Asset increase, what do you do? When asset decrease, what do you do? When equity increase, what do you do? When equity decrease, what do you do? When liability increase, what do you do? When liability decrease, what do you do? These are the fundamental. These are the golden rules of accounting. Then we go to effect B. Effect B is what? Is to credit. That means asset of equipment from 15,000 has reduced what? To 13,000. And when asset reduce, what do you do? Reduce by 2,000. What do? You credit. That means effect B is what? Asset of equipment reduced. This is $2,000. When asset reduce, what do? You credit what? Equipment account. Credit equipment account with what? With the same amount, $2,000. So that's example 5. Two more example. These are fundamentals of accounting. Very, very important. Let's go to example. Example 6. T and K on May 15, 2020, T and K returned some of the equipment costing $3,000 to, you bought it from Toonstones to Toonstones. I'll always demonstrate with how I've been doing it. Assets increase, debit. Assets decrease, credit. Equity increase, you credit. Equity decrease, you debit. Liability decrease, increase, you credit. Liability decrease, you debit. This transaction, what did this transaction affect? Is it asset, equity, or liability? Let me interpret. On May 15, 2020, T and K returned some of the equipment costing $3,000 to Toonstones. Costing $3,000 to Toonstones. Costing $3,000 to Toonstones. costing $3,000 to Toonstones. So, what is it asset, equity, or liability? Don't mind me going up and down. My children are disturbing. So, pardon me for that. Okay. On May 15, 2020, T&K returned some of the equipment costing $3,000 to Toonstones. To Toonstones. Just pardon me. My children are disturbing. Yeah. Okay. What does this concern? Is it asset or liability? Is it asset or liability? Or equity? Asset or liability or equity? So on May 15, 2020, T&K returned some of the equipment costing $3,000 to Toonstones. Return some of the equipment. What is the equipment? Equipment is what is an asset, right? Returned some of the equipment costing $3,000 to Toonstones. Who is Toonstones? We bought it from Toonstones on credit, right? We bought the equipment from what? From Toonstones what? On credit. We bought from him $15,000. Then we sold part of it. We are now returning part of it back to him. So, let's just assume that this I will open the account to be debited first. We are debiting Toonstones because Toonstones is going to receive from us. That is Toonstones. This is going to, okay. Toonstones account. So, assuming yesterday, we have now returned some of the goods to Toonstones. So, Toonstones account here was still, we bought from him 15,000. We sold part of it. We sold 3,000. We sold 2,000. It remains no, not that way. Let's just put it for simplicity's sake. Yesterday we have not returned goods to what? To Toonstones. Let's assume that this place what? The debit side what? Is 0. So when Toonstones give out, we credit Toonstones. So when we receive now, it's going what? Because Toonstones what? Is a supplier, right? When he give out, we credit. Toonstones is a supplier. When he now receive, when he receives, okay, no. Return some of the equipment costing. So let's open equipment first. We have our equipment account. Equipment account. From equipment account, this is equipment account. Let's see that our equipment account, the value is there. The value was there. What is the value? We bought 15,000 and we sold 2,000 out. We bought 15,000. Then from 2,000 it reduced to 13,000. We sold part of it, 2,000. From 15,000 it reduced to what? To 13,000. So we are still going to return. Part of it is 3,000. So from 3,000 it's now reduced to what? Assuming yesterday we have not returned, the account still remains 2,000 and 13,000. But today, being May 10th, is supposed to be here. Being May what? May 15. Being May 15. Assuming that yesterday, May 14, the account still remains 2,000 here. But this, we sold part of it to who? To J. Jerome. To J. Jerome, there's no space. Please, bear with us. So we now again return part of it. Return what? To who? To Toons. This is going to be Toons account. With what amount? $3,000. Can see 15 we reduce 2,000, remain 13. We are still going to reduce what? 3,000. That means reduction. When assets decrease, what do? When asset decrease, what do? You credit. Now remain what? Remain 13,000. Remain 13,000. Remain 13,000. But as I'm reducing this one, in account, you don't reduce it. You leave it like, but to show the reduction, you don't reduce this way. Just you leave that figure, 15,000. You are still going to balance it. This is supposed to be to remain 15,000, but I'm just showing it for simplicity's sake. In account, you don't reduce this figure. Remain, because you are still going to balance it at the end of the day. So now, okay, because I've been doing like that, let me just leave it this way. Let me leave it this way. Account, you don't change this figure. Remain like that. At the end of the day, you are still going to what? To balance and know the amount you are supposed to. Oh. Let's just leave it this way. Let me do this way. Or let me put 15,000 back here. Look at it. In the first place, when we reduce this money, 2,000, what is the balance? If we remove 2,000 from it, it's going to be 13,000. So further reduction, 3,000 again. When it is 3,000 plus 5,000, for 2,000 plus 3,000, giving us 5,000. When you deduct 5,000 from 13,000, the balance is going to be what? It's going to be 10,000, right? In account, you don't change figure, you leave it that way. But for simplicity's sake, for the sake of the learners, but I will from this point, I will not cancel the figure again. It's just simplicity. For simplicity, that's why I was cancelling what? Those figures. To show that it reduced, it increased, it reduced. Okay, let's go ahead. Let's go further. Toons account. Returns back goods to what? What's the amount? $3,000. When Toons sold out, we credit in, right? Then when Toons now receive, we are going to what? Toons what is a liability account to us. That's liability. When liability decrease, what do? You debit. When liability decrease, what do? You debit. Toons account is a liability account. So as soon yesterday, we have not returned goods to him. It's still what? It's 3,000. The account is what? Was still how much? $15,000 they were owing him. But today we are returning part of the goods, $3,000. $2,000 what? Dollar. So the first place when he sold the goods to us is $15,000. So how much are we owing Toons now? We are owing him what? We are owing him $12,000. That's balancing. That's the balance. That's the balance, right? So the effect now, what we are concerned here what is just transaction, effect, and action. This is just to demonstrate what is going to be double entry of it. So effect A is that, look at it. When liability decrease, what do? When liability decrease, what do? You debit. That's liability decrease. You debit with 3,000. Equipment reduce, what do? You credit. So number one is what is liabilities to Toons reduced. And when liability reduced, what do? You debit. Liability reduced, what do? You debit. Then debit Toons accounts with What's the amount? $3,000. What is the other effect? B. The effect is that equipment account has reduced. That means asset of, I'm going to rub off here, asset of equipment reduced. Asset of equipment reduced. Sorry, this is increase and this is reduce. When assets reduce, what do? What do? You credit. Then we credit equipment account with $3,000. So that's the end of the sixth example. Tombstones here. Okay, that's sixth example. Remain one more example to go. These are fundamentals. Just one more example to demonstrate. If you have been deriving value all along, don't forget to subscribe. And if you are a new subscriber, don't forget to subscribe. If you are an existing subscriber, don't forget to share our video to your friends and students for at least to have a wider coverage. Okay, last example, on May 10th, on May 31st, 2020, so some equipment, on May 31st, pay 12,000 to equipment supplies. On May 2020, T&K paid on May 2020, T&K paid $12,000 to Tombstones, that's suppliers, to Tombstones by check. By check. So what is the effect of this? On May 31st, 2020, T&K paid $12,000 to Tombstones by check. I will demonstrate again. Assets increase, what do? You debit. Asset decrease, what do? You credit. Equity increase, what do? You credit. Equity decrease, what do? You debit. Liability increase, what do? You credit. Liability decrease, what do? You debit. So let's so what is this transaction? Which one does it affect? Is it asset or equity or liability? Asset or equity or liability. So on May 31st, 2020, T&K paid $12,000 to Tombstones by check. Something goes out. Something receives it. What goes out? $12,000 goes out. From where? From bank. Bank is what? Is an asset. Bank is an asset. Who receive it? Toonstones receive it. Toonstones is what? Is a liability to us, as I've been saying. Toonstones is our supplier. We are liable to pay what? Toonstones, the balance of 12,000 naira. You know, he sold 3,000, he sold 12,000, 15,000 to us, and we return 3,000, remain 12,000. That is the money that Tanke is paying to Toonstones. So Toonstones is what? Is a liability. So asset now. What happened to our asset that we pay? What happened to Toonstones, to T&K bank account? He paid $12,000 from bank. That means asset of bank account has reduced. So let me demonstrate with that. Asset, that is bank account. Bank account. This is dollar sign. Bank account. That means from the bank, he's giving out $12,000. Giving out $12,000. When asset is given out, what do you do? You credit, right? Then liability now is receiving. Toonstones. We are liable. T&K is liable to Toonstones. That means Toonstones what? Is a liability account. When liability is reducing, what do? You debit. Toonstones we are owing, T&K was owing 15,000, but he returned 3,000. What is the amount that remain? From 3,000 reduced to what? To 12,000. Is he reducing more? That 12,000 now is what? It's now being reducing. When it's now reducing, that means you reduce to what? To $0. You debit Toonstones with $12,000. Look at it. Credit, debit. Liability reduce. You debit. Asset reduce. You credit. So for simplicity, let's just leave it this way. Let's not put the other side. Okay. The effect now is what? Is effect A. What is the effect A? To debit. The liabilities of money owed to Toons reduced. When liability reduced, what do? You know what? You debit Toonstones account with $12,000. Don't forget, I said I'm going to give tips. Say 5 accounts. I've given 3 accounts. There still remain 2. I'm still going to give it. That's golden rule of financial accounting. Golden rule of financial accounting. Assets, equity, liability, income, and expenses. What happened to income? What happened to expenses? After the example, I'm going to give that. Okay. What is the next thing? Effect B. I'm not sure whether I put this figure in the 6th example, but what we just need is debit. What is action? Debit or credit. Okay. What's the next now? The next is that Toonstones. We have debited Toonstones. Then we credit what? Bank account. That means asset of money in the bank. Reduced. reduce. When asset reduce, what do? You credit. Asset reduce, what do? You credit. That means credit bank account with the same amount, $12,000. $12,000, that is 12,000. That's double entry. Simultaneously with the same amount. Okay, that's the end of the example. That's the end of the example. You want to grab the principle, rewash and rewash the video, plus the other video of the effect of transaction on the balance sheet items. Balance sheet items of what? Of the same thing, asset, equity, and liability, and how balance sheet has been balanced at every point in time. What is every point in time? At every date. But in this case, it is transaction, effect, and the action to take. Okay, let me now increase the order. Here I made mention of what? Of expenses. Let me put expenses here because it goes together. Expenses. When expenses increase, what do you do? Increase. Oh, let me know what do you do. When expenses increase, what do you do? You debit. Expenses decrease, what do? You credit. Let me put it this way. When expenses increase, you debit. Expenses decrease, you credit. It is arrow showing increase and reduction. So the other one that goes together with equity, liability is what is income or revenue. Income or revenue. When income or revenue increase, what do? You credit. When income or revenue decrease, what do? You debit. This is what? These are the 5 accounts in financial accounting. We have 1, expenses, 2, assets, 3, equity, 4, liability, 5, income. So that is the end of the what? Of the video. Don't forget to subscribe if you're a new subscriber, and if you're an existing subscriber, do continue to share our video. And if you are a new subscriber, also subscribe to us and also share the video as well for the video to have a wider coverage. And by doing that, you are encouraging us to upload more and more videos like this. And whenever we upload, YouTube will be able to notify you of our YouTube algorithm will be able to notify you of our video. Thank you. See you in the next video.